Today, inflation isn't vanquished yet. Hello again, it's Martin North from Digital Finance Analytics, world latest post covering finance and property news. Well, we got the latest inflation figures from the US today, and whilst headline inflation dropped, core CPI was actually up a bit, and in fact was higher than the first number. And in Canada, the Bank of Canada left interest rates at the same level, 4.5%, but in fact Macklem was more bullish, it seems to me, about where rates may have to go later. And certainly, again, the message was inflation is not yet beat. So we're going to briefly look at this set of data because it does underscore one clear thing. Anyone who thinks that inflation is beat and interest rates are going to drop like a stone are kidding themselves. This is a long, slow grind. And interestingly, of course, Macklem also made the point that there's a massive lag between lifting interest rates from a monetary policy perspective and seeing them translate through into the real economy. Typical lag of maybe 18 months or so. So this is going to mean higher rates for longer. And I suspect you can pretty much argue the same for every economy around the world where central banks have reversed course to try and tackle inflation. So as I said, overnight, the Bank of Canada held the rate at 4.5% for a second straight meeting.
Thank you, Paul, and good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss today's policy announcement and our monetary policy report. Today, we maintained our policy rate at 4.5%, and we are continuing our policy of quantitative tightening. We are encouraged inflation is declining, and we are seized with the importance of staying the course and restoring price stability for Canadians. Inflation is coming down quickly, and it's forecast to be about 3% this summer. The economy is expected to grow modestly, even as inflation comes down. This is good news, but is not job done. Our destination is the 2% inflation target, and several things have to happen to get inflation all the way back to the 2% target. Inflation expectations have to come down further, service price inflation and wage growth need to moderate, and corporate pricing behavior has to normalize.
And the policy statement does retain a tightening bias. Macklem pushed back on market pricing for a rate cut later this year. And by the way, GDP growth is expected to be weak through the remainder of this year after a strong start to 2023. The statement today was widely expected and prompted little market reaction. If anything, probably the policy statement and the NPR leaned a touch hawkish, with the Bank of Canada clearly wanting to see more evidence of easing wage growth, slowing services inflation, normalization of inflation expectations to be confident that inflation will return to target on a sustained basis. And interestingly, he specifically mentioned the issue of profits, corporate profits in particular, needing to come back into line. Now, banking turmoil has eased market odds of a Bank of Canada restarting its tightening cycle, but today's statement seems to be a reminder that the bank has a tightening, not an easing bias, and investors might be underestimating the potential for future rate hikes. In fact, Governor Macklem said market pricing for cuts later this year doesn't look today the most likely scenario to us, he said. Now, there are a number of people arguing that the Bank of Canada is likely to remain on hold through 2023 and that the next move is more likely to be a cut perhaps early next year than a hike, but it all comes down to economic activity. If economic activity doesn't slow in the coming quarters, then the economy will need to actually be strangled further. But the point is, if economic activity doesn't slow in the coming quarters, then the Bank of Canada will need to deal with the excess demand currently related to a supply later this year, which means rates may well move higher. The Bank of Canada's inflation forecasts actually little changed, with CPI still expected to slow to around 3% by the middle of the year, but not returning to the 2% target until the end of 2024. And it said getting from 3% down to 2% could prove to be more difficult amid still elevated inflation expectations, stubbornly high wages growth and services inflation, and yet to normalise pricing behaviour. The latest Business Outlook survey showed some improvement in those areas, but clearly the Bank of Canada wants to see more progress in upcoming quarters. Indeed, it said those indicators as well as core inflation will be key to future monetary policy decisions. The Bank of Canada's 2023 growth forecast was revised higher to 1.4% from 1% previously, but that was offset by a half a percentage point downward revision in 2024, now 1.3%, and a stronger than expected start to the year at 2.3% annualised in the first quarter versus 0.5% in the January MPR, largely explains the upward revision, with growth expected to be weak, averaging less than 1% for the rest of the year. That still reads as an upgrade from the previous expectation that activity would stall through the middle of 2023, and that a couple of quarters negative growth was just as likely as slightly positive growth, though Governor Macklem downplayed that change in his press conference, but did make the point that being close to zero, you could go slightly under rather than slightly over. The upcoming softening economic activity is expected to be broadly based, with consumption growth moderating as tighter monetary policy continues to work its way through the economy and weaker foreign demand restrains exports and business investment. The Bank of Canada expects US growth will also slow considerably in the coming months, due in part to further tightening credit conditions following recent stress in the banking sector. And there was limited mention of potential tightening credit conditions in Canada, by the way. But the Bank of Canada continues to assume a 2.5% long-run neutral interest rate, unchanged from a year ago, but still 25 basis points below its pre-pandemic estimate. And there was some expectations that the neutral estimate could possibly have been revised higher today, but it wasn't. So the point to make here is that the economy in Canada is doing okay, but inflation is still well above where it needs to be. And he kept underscoring the fact that there's a long lag between lifting rates and seeing the effect in the real economy. So I still think there's more likelihood of more rate rises later. And the market's pricing of a rate cut later in the year I think are completely unrealistic. Now let's look across at the US. Now, headline CPI growth in the US moderated to 5% in March, lower than consensus expectations. Energy inflation plunged on lower gasoline and fuel oil prices. Energy prices actually fell below year-ago levels, down 6.4% for the first time since January 2021. But food inflation was at 8.5%. Sure, that slowed year over year in March, and it was actually at 0% for the last month on a seasonally adjusted basis. That was the slowest monthly change in 2 years. Excluding food and energy products, core CPI, though, rose by 5.6% from last year, or 0.4% on a seasonally adjusted basis from February, with surging rent costs again explaining much, actually 65% of the monthly increase. But even excluding energy services and rent, the core services excluding shelter index, that's Fed Chair Powell's preferred measure of domestic inflation pressures, still rose by a larger than normal 0.4% from February. And the breadth of inflation pressures did narrow in March, but remains broad. Around half of the CPI basket, excluding rent, is still seeing at least a 5% inflation number on an annualized 3-month basis in March. The bottom line is this: there is still clearly firm underlying price growth pressures, meaning that another 25 basis point interest rate hike from the Federal Reserve is very likely in May. But as the growth headwinds continue to build, the chances are that that could be the last increase through this hiking cycle, but it all does depend on where inflation gets to. And once again, it's worth underscoring this point. Inflation is sticky. Inflation takes time to squeeze out of the system, and services inflation specifically is where a lot of the problems are. Now, that, of course, is more directly connected to wages growth and other factors. So whilst goods inflation is coming down and the reversal of the energy growth that we saw over the last year has come off, it is not structurally good yet. And I think we're going to see more trouble here with regard to inflation, which is why I still think the Fed has got more mileage in its raising cycle. And again, I think the market is kidding themselves if they think that the Fed is going to start dropping rates quickly this year. And I will make the point also that in Australia, of course, the markets are now pretty firmly of the view that the RBA will cut later in the year. I'm afraid I remain sceptical for the very same reasons. Inflation is deeply embedded. Inflation in the services sector is very strong. And the lag between lifting interest rates and seeing the results in the system will also take time to work through. And I'll make the final point here that global growth is expected to contract. And of course, that will put downward pressure on inflation, but not immediately. This is going to take 2 or 3 years to take out, I think. So the bottom line is this: expect inflationary pressures to be with us for quite a long time. And the markets, I think, are just dead wrong at the moment. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.